You spend 40 years playing a game where the absolute only metric of success is the upward trajectory of your bank account. I mean, the entire system trains you to hoard, to accumulate, to delay your gratification until some distant, hazy point in the future. But what if I told you that the very system that taught you how to build wealth literally strips you of the psychological ability to actually enjoy it? Welcome to USA Riff. Before we expose the incredibly uncomfortable truth about this 40-year game of wealth accumulation, do me a quick favor, subscribe to the channel, like this explainer, leave a comment down below with what you think as we go through this, and support our deep dives by becoming a channel member. Because today, in this explainer, we are digging into something the financial industry almost never wants to talk about. The truth is, the system was never designed to teach you how to spend. It was designed to keep your money exactly where it is. And for millions of Americans, this results in a devastating, lifelong psychological trap. Think about that exact moment for a second. You clock out for the last time, you pack up your desk, and those steady biweekly paychecks that have acted as the lifeblood, the absolute heartbeat of your financial existence for 4 decades, they just flatline. The saving stops. There's no more direct deposit, no more company match. And in that exact fraction of a second, the rules of the entire financial system suddenly and completely invert. You're now expected to do the very thing you spent your entire adult life actively avoiding. You have to actually spend down your principal. And this triggers what economists call the decumulation shock. Let's really dive deep into this because it is a profound behavioral crisis. The sudden transition from saving to spending fundamentally breaks the human brain. You see, the financial industry spent 40 years wiring your neurons. They conditioned you. You were trained to feel this massive dopamine rush every single time you checked your phone and saw your portfolio balance go up. You were trained to cheer for compound interest, right? And conversely, you were trained to feel a cortisol spike, a literal biological threat to your survival, whenever that balance went down. So when it's finally time to start withdrawing that money just to live, when you actually have to orchestrate the deliberate decumulation of your life's work, it feels inherently wrong. It feels like you're making a fatal mistake. It just feels dangerous. Section 1, the Great Retirement Paradox. So this brings us to the first major structural flaw in how we view money, the Great Retirement Paradox. It's kind of the ultimate irony of the American dream. We spend our entire adult lives sacrificing, budgeting, clipping coupons, and investing to fund this dream lifestyle. Yet, when we actually cross the finish line, we just freeze. We are absolutely terrified to touch the money. And the sheer scale of this paralysis is mind-blowing. According to some extensive data from T. Rowe Price, nearly 70% of retirees manage their money strictly to preserve their assets. Let that sink in for a second. 70%. They aren't spending to live, they're managing their money to hoard. And here's the truly fascinating part. You'd think the wealthiest retirees would be living the absolute largest, right? But the data shows that wealthier households, those sitting in the top 20% of net worth, actually cut their spending by an average of 3.1%, or about $1,800 annually early in retirement. Instead of enjoying their massive wealth, they actively restrict their lifestyles. They live like they're broke, entirely to protect the giant pile of money they just spent a lifetime building. Now, in the academic world, this phenomenon actually has a name. It's known as the retirement consumption puzzle. Standard economic life cycle models, the theoretical stuff taught in literally every university economics department, assume that a rational human being will save during their working years and then systematically draw down those assets to maximize their enjoyment, aiming to hit exactly zero on the day they pass away. But these models assume humans are cold, emotionless calculators. Reality completely shatters this model. Only about 1 in 7 retirees actually spends down their principal. Just 1 in 7. The rest are systematically underspending. They're preserving or even expanding their wealth right up until the very end. But why? Why on earth would you live like you're struggling when you're sitting on a mountain of cash? Section 2, the decumulation shock. To understand that, we have to look at the deep psychological traps that make spending feel incredibly dangerous to the average retiree. We literally have to look at the anatomy of the mind during a decumulation phase. And the primary culprit here is loss aversion. This is a cognitive bias where the psychological pain of a financial loss is approximately twice as powerful as the pleasure of an equivalent gain. Think about it. During your working years, a market dip is just an opportunity, right? Stocks are on sale. You got a paycheck covering your bills so you don't panic. But in retirement, watching that portfolio balance drop triggers a visceral physiological fear. It triggers your basic survival instinct. Because of loss aversion, retirees don't view a planned, necessary withdrawal as funding their lifestyle. when they sell shares to pay for a vacation or even just to buy groceries, their brain registers it as a permanent, painful loss of their hard-earned safety net. Let's meticulously compare the two realities here. The accumulator mindset completely relies on steady paychecks. They buy the dip, they have decades of time on their side to recover from massive market crashes. But the decumulator mindset, it is ruled by an omnipresent fear. They suffer from the physical anxiety of watching the market turn red. They fear what we call sequence risk. Every single time they are forced to sell shares to pay for their life during a down market, they are locking in permanent losses. That 40-year habit of accumulating wealth has hardened into psychological concrete. Changing that habit creates immense friction, making the simple act of decumulating feel terrifyingly unsafe to their very survival.
Section 3. The sequence of returns.
But here is the critical pivot in this explainer. This isn't just an irrational fear in their heads. The system is actually stacked with structural threats that fully justify their terror. Let me explain exactly why retirees are so afraid. Sequence of returns risk is the absolute danger that the timing of investment returns will permanently and irreparably damage your portfolio. I want you to imagine two identical retirees. Let's call them retiree A and retiree B. Both have exactly $1 million. Both experience the exact same average market returns of 7% over 30 years. But retiree A experiences a 30% market drop in year 2 of their retirement, while retiree B experiences that exact same drop, but in year 25. Retiree A is in massive, life-altering trouble. Because they're actively withdrawing funds, say $40,000 a year just for basic living expenses, they're forced to sell their assets at severely depressed prices just to eat. They are cashing out at the absolute bottom. When the market eventually recovers a few years later, retiree A has significantly fewer shares left to capture that upward growth. The structural mathematical damage is permanent. Two people, the exact same average returns, but vastly different lives decided purely by the luck of the draw. The systemic reality justifies their deepest behavioral fears. So how do you actually survive this? Well, financial institutions have built entire exhausting playbooks to try and mitigate this exact risk. You can't just blindly follow the old 4% rule and hope for the best, because the 4% rule can fail spectacularly if you hit a bad sequence of returns early on. Instead, retirees are forced to adopt these complex, stress-inducing defensive strategies. Honestly, it becomes a full-time job. They use the bucket strategy, painstakingly segmenting their money into short, mid, and long-term buckets, maintaining a massive cash buffer of 1 to 3 years of living expenses, just to avoid ever having to sell stocks in a crash. They use dynamic spending guardrails, meaning they have to actively cut back their lifestyle, cancel trips, and reduce spending the moment the market dips. They meticulously calculate proportional withdrawals across pre-tax, post-tax, and taxable buckets to avoid devastating IRS landmines. It is an exhausting, hypervigilant state of continuous financial self-defense. Section 4. The late life medical threat. And just when you think you've managed the stock market, just when you think you've miraculously survived sequence risk, you are hit with the second massive systemic threat, the one that forces retirees into an extreme, permanent lockdown. $38,000. That is the average out-of-pocket medical cost for a high-income 100-year-old in the United States. And remember, that is just an average. The unpredictability of catastrophic late-life medical costs is absolutely terrifying. You see, the government-provided consumption floor in this country, Medicare, is only designed for the absolute poorest citizens. It steps in only after you have completely and utterly exhausted your assets, forcing you to spend down to sheer poverty just to qualify for help. Medicare leaves massive gaps, specifically refusing to cover the crushing costs of long-term care and nursing homes. If you've built wealth in America, you are completely exposed to this reality. The data from the National Bureau of Economic Research paints a totally staggering picture here. The divergence in assets between the top income quintiles and the bottom is completely wild. High-income earners look at the medical reality of this country, and they rationally hoard massive assets. They refuse to spend their money on vacations. They refuse to buy new cars. They refuse to fund their own enjoyment, strictly to self-insure against the devastating risk of outliving their money in a nursing home facility. They are actively reducing their current consumption, literally suppressing their own joy today, because they know the systemic truth. The system will not catch them if they face a massive, multi-year health shock at age 95. Section 5. The mental accounting track. Because of these terrifying systemic realities, the human brain is practically forced to develop coping mechanisms. It creates an irrational framework to manage the constant, low-level fear. This brings us to a foundational concept in behavioral economics, the mental accounting trap. Mental accounting is essentially the illusion of wealth. It's the cognitive bias where we categorize and evaluate money in non-transferable mental accounts rather than treating all dollars as mathematically equal. Let me give you a really concrete example of this cognitive dissonance. A retiree might agonize for days over withdrawing a measly $100 from their IRA, but they will happily turn around and blow a $1,000 Social Security check on a new television without a second thought. To a retiree, a dollar is not just a dollar. They treat investment principal, the core of their 401k or IRA, as sacred, untouchable money. But a dollar that comes in as a dividend or a pension or Social Security, that is viewed as disposable house money. Let's break down exactly what is happening under the hood here. The origin of a dollar entirely dictates a retiree's willingness to consume it. Think about lifetime income, which includes things like a pension or Social Security. Retirees frame this mentally as a disposable paycheck. And because of that, their decumulation velocity is incredibly high. They'll spend 80% or more of it without a second thought. It just feels safe. But move over to qualified savings, your 401ks and IRAs. This is framed as structured future income. The decumulation velocity drops to moderate. And then look at checking your savings. This is framed in the mind as a core emergency buffer. The decumulation velocity here is incredibly low. People will literally sit on $1 million in an IRA and flat out refuse to take out $5,000 for a trip to Europe because touching the principal feels like a violation of their safety. The money is there, but psychologically it is completely locked away.
Section 6. A license to spend.
So if the system trains you to hoard and structural fear makes you freeze, how do you safely unlock the wealth you spent a lifetime building? You need a profound systemic and psychological shift. The research numbers here are truly staggering. Data shows that retirees willingly, comfortably, and happily spend 80% of their guaranteed lifetime income, but they only spend about 40% of what they could safely afford from their actual investment assets. This is an absolute tragedy. Millions of people are essentially self-imposing a 50% pay cut on their own lives out of pure psychological fear. They're living on half the lifestyle they can actually afford simply because their wealth is held in the wrong format. Investment assets trigger the fear of the unknown lifespan. Lifetime income completely eliminates it. And here is the truly shocking conclusion. Every single dollar converted to guaranteed lifetime income results in roughly twice the equivalent spending compared to money left invested in a volatile portfolio. I really want you to let that sink in for a moment. By simply changing the format of the wealth, taking money from a variable stock portfolio and converting it to a guaranteed annuity, or delaying taking Social Security to increase the monthly check, you are repackaging the exact same net worth to trick the brain. It is the exact same amount of money, but it generates twice the lifestyle spending. It entirely removes the uncertainty of sequence risk, and it completely neutralizes the paralyzing fear of outliving your money.
As retirement researchers David Blanchett and Michael Fink brilliantly put it, essentially, annuities with lifetime income protection give retirees a psychological license to spend their savings. Funding a lifestyle is what motivates people to save, and few indicate a desire to pass on significant wealth at death. It isn't just about the math, it's about psychology. It's about giving yourself the emotional permission to enjoy the fruits of your decades of labor without the suffocating daily anxiety of seeing your nest egg shrink.
And the worst part? Most people will never realize it. They're going to reach the end of their lives having won the financial game on paper, but having lived like they were losing it in reality. They'll hoard, they'll stress, and they'll die with the high score in a game that no longer matters. True wealth isn't the number sitting in your brokerage account. True wealth is whether your mind actually gives you the psychological permission to spend it. If this explainer changed how you view your money, your mind, and your future, please support USA Rift. Subscribe to the channel right now, like this explainer, leave a comment below with your thoughts on the decumulation shock, and become a channel member to help us keep exposing how the financial system really works. Until next time, stay focused and rethink your wealth.